You know, when you think about finance, the future is this big, scary unknown, right? Prices go up, prices go down, it's a ton of risk. But what if you could tame that risk? What if you could actually make a deal right now to lock in a price for something way down the road? Well, that's exactly the idea we're going to demystify today.
So this really is the core question. Let's say you're running a business and you know you need to buy something essential in, I don't know, a few months, but you're worried the price is going to go through the roof. Or maybe you're on the other side, you're selling something and you're terrified the price is about to crash. How do you get any kind of certainty in a world like that?
Okay, let's make this super concrete. Think about an airline. They know for a fact they're going to need millions of gallons of jet fuel in, say, 6 months. And on the flip side, you've got an oil producer who knows they'll have millions of gallons to sell. The airline is worried sick about prices going up, and the producer is just as worried about prices going down. See? They have the exact opposite problem, but they both desperately need the same thing, a predictable price.
And that, right there, brings us to the solution. There's this whole set of financial tools that were literally designed for this kind of future-proofing, and they have a name: derivatives.
Okay, so what on earth is a derivative? Well, at its very core, it's just a contract. But the tricky part is its value isn't based on itself. Its value is, wait for it, derived from something else. That something else is what we call the underlying asset. And it could be pretty much anything: a commodity like oil, a company's stock, even something as abstract as an interest rate. The clue, is right there in the name.
All right, so who's actually using these things and why? It's pretty interesting, actually, because it basically boils down to two main reasons, and they couldn't be more different. They're almost total opposites.
Okay, so on one side of the coin, you've got what's called hedging. This is all about playing it safe, right? It's about reducing your risk. Remember our airline and oil producer? That's exactly what they're doing. They're hedging. They just want to lock in a price to avoid any nasty surprises. But then, on the other side, you've got speculation, and this is about embracing the risk, trying to make a profit from those exact same price swings. And here's the crazy part. These two groups totally need each other. The speculators are the ones willing to take on the risk that the hedgers are trying to get rid of.
All right, let's dive into the toolbox and pull out the first big one. It's called a futures contract. The best way to think about it? It's like a super serious, legally binding handshake on a deal that's going to happen later.
So how's it work? Super simple, really. A buyer and a seller agree on a price today for something that'll be delivered in the future. So for example, they might shake on a deal for, say, $56 a barrel for 1,000 barrels of oil to be delivered in 3 months. But here's the kicker, and this is important. This is not optional. It is an obligation. That deal must be completed at that agreed price. I don't care if the market price goes to the moon or crashes to zero. Both sides are completely locked in.
Okay, let's grab the next tool out of the box. This one offers a lot more flexibility. It's called an options contract. And if a futures contract is that binding handshake, think of an option as being more like an insurance policy.
This is the single most important difference, so really lean in here. A futures contract, remember, is an obligation. You have to do it. But an options contract, it gives the buyer the right to buy or sell. But, and here's the key, not the obligation. You pay a little fee for that choice, it's called a premium, and that flexibility, man, that changes everything.
And these options, they basically come in two main flavors. First, you've got a call option. This gives you the right to buy something at a set price. You can think of it like you're calling the asset over to you. The other flavor is a put option. This gives you the right to sell something at a set price. You get to put it on to someone else. See? Call and put.
Okay, so that's the million-dollar question, isn't it? You've paid money for this option, this right. So when is it actually profitable? How do you know if it's even worth using? Well, it all depends on whether your option is what traders call in the money.
Okay, let's break this down. That price you agreed on in the contract, that's called the strike price. Now for a call option, that's your right to buy. You're in the money if your strike price is lower than the current market price. I mean, think about it. You get to buy it for cheap. It's a great deal. For a put option, your right to sell, you're in the money if your strike price is higher than the market. You get to sell for more than it's worth. And what happens if things go the other way? Well, then your option is out of the money, and you just let it expire. No harm, no foul, you just lose the small fee you paid for it.
And this right here is where you can really see the massive power of options, especially for speculators. Get this. In one example from our sources, an investor paid a premium of 20 for an option. The stock went the right way, and they made a profit of 10. Now, you might think, 10, so what? But wait, they only invested 20 to begin with. That's a 50% return on their investment. That kind of leverage is exactly what gets speculators so excited.
So okay, we've seen how these things can be used for playing it safe and for taking big risks. But believe it or not, their role in the whole financial system is even bigger than just those two things.
Yeah, I mean, beyond just hedging and speculating, derivatives are absolutely crucial for stuff like arbitrage. That's a fancy word for when traders find tiny little price mismatches between different markets and scoop up a basically risk-free profit. They also let huge investment funds quickly change up their strategy, their asset allocation, or even invest money they know is coming in the future so they don't miss out on market moves while they're waiting for the cash to actually hit their account.
And this really gets to the absolute heart of it all. There's a quote from one of our sources that just nails it. The thing is, derivatives themselves aren't good or bad, safe or risky. They're just incredibly powerful tools. The result you get, whether it's safety and security or a wild gamble, it all comes down to the strategy you choose to use.
So where do we land? What are these things, really? Are they just a sophisticated insurance policy that helps businesses navigate a chaotic world and keep the whole economy humming? Or are they more like a casino ticket? A high-stakes bet that can lead to massive wins or devastating losses? Well, the truth is, as we've seen, they're both. It all comes back to a simple question. Who's holding the tool and what are they trying to build with it?